Hello and welcome to Market Domination, sponsored by Tasty Trade. I'm Julie Hyman, that's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Even though we got that announcement last night on 25% tariff on Canada and Mexico, I'm looking for some flexibility. Is it going to be 25%? Are there going to be sectors that are going to be exempt because particular sectors impacting his base more than others?
I think this is a very interesting development. For months now, we've been hearing about Doge, and it was really just a couple of outsiders opining on what the federal government should look like. Didn't really have any authority. With this executive order, the president has essentially renamed the United States Digital Service and given it a task. The narrow task appears to be to modernize technologies in the federal government. Seems like a sensible task for an Elon Musk.
From the business side, that's the major part of this message, which is less regulation, tax regime stable, investments in America, and for mid-sized companies and small companies in America, that's great news.
We got 1 hour to go until the market close. So let's take a look at the major averages here. We see this rally one day after the inauguration of Donald Trump. Take two. We've got the Dow trading higher by 448 points, about a percent here. The S&P 500 up 0.75%, and the Nasdaq up a little more than 0.5%. And at least some of today's rally seems to be centered around the idea that it could have been worse in terms of tariffs. Specifically, we don't see President Trump immediately imposing tariffs on China. He is talking about some ones coming soon for Canada and Mexico.
Yeah, it was last week we were talking about the broad rally, Julie, and we were here talking about cooler than expected inflation data and solid bank earnings. Today, the good times continue. I think you're right. At least part of this story is investors, at least right now, seem to be focusing on pro-growth, pro-business Trump policies and thinking, you know what, at least initially maybe the trade and tariff talk, the talk at least wasn't what some might have expected.
Right. We talked to John Hilsenrath yesterday, who was with us here for the inauguration, and he kept saying, pay attention to what Trump did not say in his inauguration comments with regard to tariffs and other things. Let's take a look at some other things that we're watching in the wake of and reacting to all of this. We've got yields that are lower today. Similar theme here, down 4 basis points. And we continue to watch the U.S. dollar really closely here because the dollar versus particular other currencies is very reactive here. We have here the Canadian dollar still lower on the day, but up off the lows versus the dollar. But the U.S. dollar index down here, again, on some of this tariff stuff coming off the boil, maybe.
Yeah, one name that's not joining in the party today, Apple, iPhone maker, well in the red. It was down about 4% last I checked. Picked up a couple analyst downgrades. We're going to talk to an analyst later in the show about that name straight ahead.
We are. It's down about 4% right now. And then I also want to talk about, as we're looking at the sort of ripple effect, the different things from the speech yesterday, I'm looking at retailers here. And there seems to be a little bit of a particular lift for the retailers because the thinking is, for example, for a Home Depot or Lowe's, or I saw Dollar General, although it's up less than it was earlier, but actually it's up 5%. So some relief here that their goods that they sell in their stores won't be tariffed necessarily, that they won't have to deal with the question of whether to push costs onto consumers that are already pretty sick of inflation. So maybe a little bit of a relief there for now, at least.
For now.
We'll see if it lasts.
Just the person to ask about.
We do.
For now,
because it is the first full day of Donald Trump's second presidency. And in just over 24 hours since taking the oath of office, the 47th president has signed around 50 executive orders, including cracking down on immigration, declaring a national emergency on energy, and halting a ban on TikTok for 75 days. For more on Trump's first day in office, and what the next 100 days could be like, for example. Joining us now, Libby Cantrell, PIMCO's head of U.S. public policy. Libby, we were just talking about the tariffs here and this relief that we are seeing manifest in the market that China was not targeted. But I think China not being targeted yet is kind of the key piece of that. What can we expect on that front, do you think? What should we be watching for?
Yeah, and good afternoon. I mean, I think sort of the general message that we are sending both our traders and also our clients is that this may be maybe a reprieve in terms of tariff action, but not necessarily a total absence of future tariff action. So my own view is that we shouldn't extrapolate too much from the fact that there wasn't any formal action yesterday. Of course, there was quite a lot of rhetoric in the Oval Office about the possibility of tariffing both Canada and Mexico. But broadly, President Trump is quite ideological about this. This is a deep-seated view of his dating back to the 1980s in terms of the effectiveness of tariffs. As we've said before, he believes that tariffs really aren't a problem. They are, in part, a solution, particularly as it relates to the trade deficit. So again, while the market there may be a bit of a relief rally here, I think that we shouldn't extrapolate too much or take sort of too much comfort from, again, the absence of formal action yesterday.
Libby, what the Journal is reporting is that there's kind of friction in Trump world, right? That you have one camp that says, let's go big, let's go bold and aggressive when it comes to tariffs. But there's another camp that says, hold on, let's stay narrow and targeted. On China specifically, Libby, and tariffs, I'm just curious, what are you telling clients? I mean, as you try to gauge this out, place your bets, what do you think could ultimately emerge there?
Yeah, I think it is. I mean, we obviously should caveat that this is all speculating. I mean, the ultimate economic advisor for President Trump is the president himself. So, even his closest advisors will always caveat that, of course, he can sort of change his mind and he will, push forward with policy as he sort of sees fit. As it relates to China, obviously, I think the TikTok ban might complicate some actions here. The president has said that he wants to go over to China, that he wants to see a sale of TikTok and the Chinese approving of that. So potentially he's holding his fire on China. But again, as we've been sort of telling our clients, really the lowest hanging fruit, politically speaking, at least as it relates to Capitol Hill in particular, is on China. There's already a live Section 301 investigation, meaning the president doesn't have to proceed with a new lengthy investigation to impose new tariffs on China. He can simply use the already activated one. And so I think, again, we've sort of cautioned that the direction of travel here on China in particular, because of that political support, is quite clear that tariffs are very likely going to go up. But this is sort of tariff man meeting transaction man, and President Trump does like a deal. So potentially he's holding his fire as it relates to TikTok. But again, we would just say don't take too much comfort in no action yesterday, because we do believe tariffs are coming, and maybe sooner than the market may like.
Well, then does that also suggest that this was only a temporary reprieve in terms of the upward march in bond yields, right? If there are going to be tariffs, if they are going to cause upward pressure on inflation, add to that the fiscal spending that we could see from this administration, is it just a matter of time till we see 5% on the 10-year?
Yeah, Julie, I do think it was interesting that the president didn't mention deficits or debt once in his inaugural speech. In his executive actions that you enumerated at the top, there was really very little focus on spending cuts in particular. With that said, tariffs cut both ways. They can be inflationary, but they can also impact growth, especially if countries retaliate against the United States. So they're not necessarily all that linear in terms of their impact. And again, they can impact growth just as much as inflation. And actually, depending on sort of the FX response, and you guys mentioned the stronger dollar, they can actually hurt growth more than they can hurt inflation, impact inflation. So I don't think the direction from a bond yield perspective is exactly clear here. And as we've seen with the markets pricing, and some of it's been obviously on tariffs and risk of tariffs, but a lot of it has just been about the economic data and the resilience of, inflation and questions around the Fed. I think we at PIMCO have sort of faded a little bit of the backup in yields recently, thinking that the Fed will cut, before the market had expected it to, and that obviously over the last week or so has played out. But again, tariffs hit both ways, and I don't think it's not exactly clear from an economic perspective what the impact would be.
Libby, I want to ask you about taxes too. I was speaking recently to another policy analyst And he made a call there, Libby. It was just interesting, one I hadn't heard of before. He said, I think investors, he told me, should brace for the possibility that you actually see a bump up in the corporate tax rate as Congress looks to offset an extension of individual tax cuts. Sort of an interesting take, Libby, a bit of a contrarian one. I was just wondering what you made of that.
I do think that's contrarian. I think that's very unlikely. The budget chairman has talked about potentially increasing the corporate tax rate as a potential offset. There was a lot of pushback on that idea. So I think that's quite unlikely. However, I do think that there will likely be some pay-fors. So, as Julie was just talking about in terms of the impact on bond yields, we are likely to see some offsets to a tax package. Now, extending the Trump tax cuts on the individual side, as you all know, is very expensive. $4 trillion plus over 10 years, obviously even more expensive if it's made permanent. But I do think that there will be some movement to try to offset at least part of that. And the rollback of the Inflation Reduction Act, maybe some spending cuts to Medicaid and to SNAP, and some, a kind of cats and dogs, if you will. But I think the corporate tax rate, at 21% is pretty much sacrosanct in the president's eyes. And if anything, I think you could see him push for a decline of the corporate tax rate for U.S.-based manufacturers. That's at least what he campaigned on.
Libby, it's interesting, the rhetoric that we heard about the U.S. sort of being open for business again. If you look at foreign direct investment in the U.S., it's actually at a record right now as a percentage of the global total. We have a chart from the FT that shows that, especially versus other nations in which we are in competition, I think, as Trump would view it. How do you view this? Do you think that this is going to continue to trend higher under the Trump presidency? And how is dollar strength going to potentially affect all of that?
Yeah, I mean, Bill Gross, the PIMCO's founder, used to have a saying about the U.S. being kind of the cleanest dirty shirt, that in a closet full of dirty shirts, the U.S. was maybe a little bit dirty, but relatively cleaner, on a relative basis. And I think that is absolutely true, maybe even on an absolute basis, just given dynamics in Europe and then also in Asia. So I think we would continue that investment to continue, although obviously every kind of economy has it's just a natural economic cycle. So for how long can the consumer, for instance, stay in there and what have you, I think is an open question. But yeah, I think President Trump made it very clear that the U.S. will continue to be open for business.
And also that was made abundantly clear by those who were in attendance at the inauguration, of course, the various tech CEOs, but not just tech CEOs. The CEO of Walmart was there, for example. And I have to wonder about the sort of risk reward of that alignment. I mean, you look at one of those executive orders that we didn't talk about, of course, was Trump pardoning about 1,500 people that attacked the U.S. Capitol on January 6th of 2021. So many of those CEOs had spoken out on January 6th, 2021. So how do you think about the corporate landscape? Are these folks risking landmines?
Yeah, I'm not sure that's really a position. I'm not really in a position to sort of opine on that. Although I do think that companies just in general, maybe both from that experience of January 6th, but also some of the experiences during the Biden administration, I think a lot of them have appreciated that maybe they shouldn't be opining on sort of various policies and politics. And I think you did obviously see many members of the tech community at the inauguration yesterday, but there were lots of folks who weren't there. And I think a lot of folks have decided that maybe they'll kind of stick to their knitting as it relates to their own businesses and maybe not necessarily opine on kind of every policy or every kind of action or what have you. The technology folks, though, I do think are big is bad in Washington, and so I think they're trying to ensure that if there is any kind of future regulation or if Congress acts on, say, social media or what have you, or data privacy, that it is more kind of industry friendly than maybe it would have been under Biden. So I think that in some ways they view the risk coming out of Washington maybe as more existential than other industries. So they have done that risk reward kind of calculus and have decided that there's more upside than downside. But I do think it was interesting. You didn't see a lot of Wall Street folks, for instance, at the inauguration in terms of, big established banks and what have you.
Some of them have already flown to Davos, Libby, I guess. Thank you so much for your time. Appreciate it. Good to see you.
Good to see you.
We're just getting started here on Market Domination. Coming up, we'll get you out to Davos, Switzerland, as the 2025 World Economic Forum has kicked off its annual meeting. Yahoo Finance's Brian Stassi and Jennifer Schonberger will be sitting down with executives and experts across a range of industries, including a conversation with Coinbase CEO Brian Armstrong. You'll see that in the 4 p.m. hour. And you can scan the QR code below to check out all of our coverage throughout the week. In the meantime, stick around. Much more Market Domination still to come.
Stocks higher to kick off the second Trump era, but as investors digest the president's first policy moves, many wonder if they will be inflationary. For more, let's welcome in now Stephanie Lang, Homework Berg Chief Investment Officer. Stephanie, it is good to see you. So I want to start off with what we're seeing in the market today, Stephanie. The Dow right here, we're up almost 500 points. What do you make of that, Stephanie? What explains it?
Well, I think, the news today was really that Trump didn't come out with a bang with these executive orders and really surprise the market with inflationary pressures that weren't expected. So with Trump saying they're going to study the trade policies, we can breathe a sigh of relief. And, we're still waiting for what's to come. So I wouldn't put that too far away. But I think that's what the market's reacting to now.
So, Stephanie, how are you thinking about it then in your strategy? What are you watching for to try to determine whether we are going to see something at some point that is going to continue to maybe reaccelerate inflation, for example?
Yeah, I think, we're in a good spot. We've had really good economic data, good employment. GDP now is at 3%. People are spending. But what could derail that? And I think the main thing we're keeping an eye is on interest rates, and what could really push that higher is inflation reigniting. And a lot of that really has to do with how strong the economy is. I think we're in this kind of inflection point where we need things not too hot, but not too cold. But then also the policies are really a wild card. And so we're, it's a wait and see mode to see what Trump comes out with. What are the implications for inflation? And I think all that's going to play into what the Fed does. And I think we're okay with a pause, but if the Fed were to start hiking again to react to inflationary pressures, I think that could be something that could derail the market and we could see some declines in stocks.
So Stephanie, to your point, lots of uncertainty, but listen, you got clients, you have money to put to work. So what are you doing right now, Stephanie?
Well, our standpoint is, look, the economy's strong. Even though valuations are high, they can stay that way for a while. The consumer's in good shape. It's, the higher end consumer's feeling good because of home prices and the stock market. And so we see that continuing. So keep a full allocation to equities. I think from a fixed income standpoint, we've been doing a couple things. One, we've been inching out duration a little bit, but definitely staying on the short end. We've also been taking some of that fixed income allocation and looking at low volatility hedge funds. So some trading strategies that, keep the steady eddy going like bonds, but you don't have that rate volatility that plays into it. And lastly, one of the things that we've been doing really for a number of years now is looking at private debt. So there's a number of ways that individual investors can get access to private debt, and you can get much higher returns than the public markets. So we're trying to diversify away from just traditional stocks and bonds, and that will give a smoother ride for our clients and help them to stay put, which would, for volatility that could be coming in the form of interest rates or just, equity volatility.
Yeah, and that private debt market has gotten a lot bigger, so you have more to choose from now than ever before. When it comes to equities, though, I want to talk about earnings for just a moment because we are in earnings season. Do you think it is more of an upside or downside risk for stocks, or do you think that this other stuff is kind of trumping earnings unusually?
Yeah, I think that earnings, inevitably drive stock market returns over time. And what we're really encouraged about is we're seeing an acceleration of earnings. So from 2024, we should end up around 10%, but in 2025, that's accelerating to 15%. A lot of the concern in the market has been the concentration within the market and all the returns being driven by just, these 7 stocks or even the top 10 stocks. And all the earnings growth has been coming from there. But what I think is healthy is that we're seeing this broadening earnings growth, and we're going to be less dependent on the Magnificent Seven. And, what could concern investors is, that deceleration in earnings growth from those big cap names. And some of them are even going to be growing less than the market going forward. But I think from a health of a market rally, that's going to be important for sustainability over time. So I think we're encouraged by the fact that you're seeing more participation. We just heard from, the big cap financials. They beat and they guided higher. We're seeing the highest earnings growth in 3 years in Q4. So I think that's really important that the fundamentals are there to support a rally. And I do think, the policy noise and how that plays out is going to cause a lot of volatility. But when the market drops on some of those news, we would still be buyers because we're believers in this rally long term.
Stephanie, thanks a lot. Appreciate your time.
Thank you.
Now time for some of today's trending tickers, sponsored by Tasty Trade. You can scan the QR code below to check out the best and worst and most viewed stocks of the session on Yahoo Finance's trending tickers page. First up, we're looking at shares of Oracle, as President Trump will reportedly announce billions of dollars in private sector investment to build AI infrastructure in the U.S. That's according to CBS News. CBS is reporting that executives from Oracle, as well as OpenAI and SoftBank, will be at the White House to discuss this venture. And it's something that was sort of teased by representatives of the administration, that some sort of big infrastructure announcement would be coming.
Yeah, waiting for details. Can we talk billions in AI infrastructure? Where is that money going? Which companies? Who could be on the receiving end? A lot of times when you're talking AI infrastructure, you're talking Nvidia, right? So we'll wait to get more details there. In terms of personalities, Larry Ellison, I mean, listen, there were reports that Mr. Ellison dined with Trump on multiple occasions. He, of course, well-known longtime Republican supporter. And then it was just last month, Trump and SoftBank's Masa son we were talking about, Julie, because they unveiled that $100 billion investment in the U.S. So I wonder, is some of that in this, or could we see something different?
It's probably just, if I had to guess, I would guess that it is probably just the beginning of what you're discussing. And by the way, just checking on some of the names that you just mentioned, Nvidia, for example. I'm taking a look. I don't know if we can pull up the interactive right now, but I'm taking a look at Nvidia today, and Nvidia shares are up 2.6%. We're looking at the hyperscalers, with the exception of Microsoft, but we've got Alphabet and Amazon. Meta's higher as well. I've also been noticing that many of the power companies have been trading higher today, and let's see, are these energy companies like oil companies? These are the oil companies. But if you look at the utility companies and how they're trading today, we are seeing a big lift there. So that also may be sort of the feed through, if you will. If you're building more data centers, you need more energy, you need more power, and that's.
You mentioned the hyperscalers. I mean, of course, Larry Ellison and Oracle have moved in there as well, bumped their way in that crowd, which is why, of course, that stock has surged over the last 12 months.
Exactly.
Up next, we are looking at stocks in the space industry getting a boost as President Donald Trump places his support behind space exploration during his inauguration speech yesterday. So this one, space-related companies, they are gaining, at least some of them today. Trump pledging to pursue our manifest destiny into the stars, Julie, launching American astronauts to plant the stars and stripes on the planet Mars. Of course, Elon Musk, who was at the inauguration yesterday.
Yeah,
he did very much.
That's what he said.
Trump has been there with him shoulder to shoulder. I remember Trump actually joined Musk for SpaceX's Starship launch. So this has been part of the theme there.
Well, but of course, SpaceX isn't public. But there are a handful, at least, of direct sort of space plays that are public. Intuitive Machines, Rocket Lab are just a couple of those that you're seeing rise today. I was taking a closer look at Intuitive Machines, which made a lunar lander, a lunar module that did end up making it to the moon, although it then kind of tipped over. That is an interesting chart. If you take a look at the chart, it was a SPAC, right? So that's why it went sideways for a long time. And then when it de-SPACed, the stock spiked as high as something like $88 per share, and then came down and has sort of plugged along since then. It's gone up quite a bit over the last year. But most of these companies don't make money or don't make a lot of money as of yet. It's very early in the space cycle, but people are not waiting to get in.
And they got a fan in the White House, sounds like. Lastly, turning to the electric vehicle industry, EV makers taking a hit as President Trump issues an executive order to eliminate the EV mandate. Here to discuss this, Yahoo Finance's Praz Submarinian. Praz.
Yeah, the so-called EV mandate, not really an EV mandate, it's basically an emissions rule that it's a target that the Biden administration had put forth, basically claiming that they wanted to target 50% EV sales by 2030 or thereabouts, right? That's sort of the by use of emissions rules. Trump is now reversing that EO, getting rid of that, no longer limiting those emissions for the fleet of cars that an automaker sells, and that was going to help the GMs and Fords of the world. And you can see their stocks are up today, but conversely, the EV players like Rivian and Tesla are down today because of the fact that we're not going to have that push for EVs. But also, they get money from these emissions tax credits. That would also go away if you get rid of these emissions rules.
So I guess people expected it, but even so,
the
confirmation perhaps. I noticed also Lucid is trading a little bit lower, although its cars are so pricey, it doesn't really take advantage of those.
Yeah,
and Polestar is up, so who knows?
I mean, Julie, I got to say that I was surprised by the move in the EV stocks because we knew this is priced in. But I guess when you finally have finality in some sense, that
locks it in finally.
I guess so. Another potential pain point is tariffs, of course, that could affect the auto industry. Specifically, what are we, I mean, I know we don't know, but what are we looking for on the auto front?
So, Trump yesterday indicating that he would potentially put 25% tariffs on Mexico and Canadian products on February 1st. The automakers, in particular with Mexico, build a lot of cars there that are for sale in the U.S. That's a big headache. It's a big concern. It's a big possibility of knocking down, core profits for these companies. But there's a little bit of wiggle room there, right? The February 1st deadline, people like Tom Narayan at RBC earlier today on Yahoo Finance said that this is indicative of room for negotiation. He actually doesn't see this happening. But if it does, he also said that it would be, quote, tremendously inflationary. So not just bad for automakers, but bad for consumers because of the fact that not just cars, but car parts. Apparently every car seat, or most every car seat is made in Mexico. You can't make a car without a car seat, right? So that's sort of the things that we're talking about that could add to the price of a car, make certain automakers' cars not competitive with others, and then also just raise prices in general.
Right, and you're not talking about like a can of soda. A car is a big ticket item.
One of the biggest things you'll buy.
Put 25% on.
Yeah, exactly.
All right, thank you, Bros. Keep watching. Stick around, much more market domination still to come.
President Trump wasting no time at the start of his second term, signing a heavy load of executive orders on Inauguration Day. Big banks such as JP Morgan left trying to decipher what the start of Trump 2.0 means for the industry. JP Morgan head of asset and wealth management, Mary Callahan Erdos, speaking at the World Economic Forum, pointing to the long hours in digesting the load of incoming changes.
There's going to be a lot of changes that we all have to digest. At JP Morgan, we have a war room set up to analyze and evaluate each and every one of these. So they've been up all night and are working on it. And I think that, time will tell.
For more on how banks are looking at the new Trump era, let's get to Barclays senior equity analyst Jason Goldberg. Jason, it's good to see you. So it sounds like JP Morgan's doing what most of us are doing, which is just trying to sift through the fire hose, whether it be executive orders or whatever's going to come in the days to come. Looking for the bank's businesses specifically, what do we see signed perhaps yesterday that will have the most direct impact, or is that thing still to come?
Yeah, no, certainly. If you look, ever really since the financial crisis, you've seen, bank regulation get increasingly more challenging, particularly around capital. And I think what the new administration has the ability to do is take a more holistic approach to bank capital regulation. So you've seen this kind of Basel III endgame proposal that's been in the works for the last several years that was quite onerous. We look, for the regulators to kind of come together and look at that, in a more holistic approach with things like bank stress testing and the like, which ultimately will allow the banks to manage their balance sheets more freely and be able to more easily lend to their customers.
I saw reports, JP Morgan's co-head of global banking saying there's euphoria was the word among clients, pro-business administration, the backlog. I'm just curious, you look ahead, you see what in terms of M&A, IPOs?
Yeah, no, certainly. So it's not only like you could look at certainly, less regulation helping the banks, but it's certainly more broader. And to the extent that you get, I would say, an easier pathway to more kind of merger approval process, there seems to be a lot of pent up demand for corporate M&A activity, really across all sectors. In addition, IPO activity last year was running at like 50% of historical averages. So there too, there's some pent up demand both from corporates as well as sponsors. So while investment banking fees for at least the US-based banks rose, 30% or so in 2024, we do see, a fair amount of further upside into 2025 and potentially 2026, just given all this pent up activity.
And who in your coverage universe is best leveraged to capitalize on that?
Yeah, no, certainly, the biggest banks are certainly geared for that. So Goldman Sachs, Morgan Stanley, you mentioned JP Morgan, along with B of A and Citigroup would certainly be up there to take advantage of both the rebound in IPO as well as M&A activity.
So all of that aside, we're coming off of already a record revenue period for the banks, looking at most of the ones that have reported so far. So what obstacles would come in? Or is it just sort of upside as far as the eye can see?
Yeah, no, certainly, banks are a reflection of the economy. But, as long as the economy is growing, unemployment, rate remains in the low 4% area, and the yield curve has some steepness to it, banks should be able to, continue to put up, mid-teens ROTCEs, and decent growth. One area, that's been absent has been loan growth. It's been fairly slow to come back. As 2020 progresses, we'll see. But for a lot of banks, particularly the smaller banks, which we haven't discussed, that is a big driver of their earnings growth, and that's kind of been more subdued of late. And there's also several pockets of credit quality we're keeping an eye on. The lower end consumer is still quite stressed given elevated inflation. Commercial real estate, particularly office, continues to bear watching. Obviously, well telegraphed secular shifts going on there. And just pockets of, commercial loans you have seen elevated losses, so you're watching that as well.
I'm curious, Jason, with this administration, and we've been talking to strategists, of course, a lot about this, there's still so much uncertainty with taxes and tariffs, trade, in terms of how that could affect the broader economy. Do you try to model all that? If the economy stays strong, who benefits? But if fiscal policy has, negative consequences, okay, who's better positioned in that scenario?
Yeah, no, certainly there's a lot of permutations, this can take. I think we feel somewhat comforted by the fact that, banks enter this period of maybe somewhat uncertainty with record capital, very strong liquidity, relatively low loan losses. So can really handle, a multitude of different outcomes. But certainly you mentioned, what goes on with tariffs or taxes or immigration and how does that impact, inflation and interest rates and economic growth will certainly feed through the banking system. But, we think they're well positioned to handle, many different outcomes.
Yeah, there was also some discussion about loan demand from the banks for last quarter. Do you think that there is room for that to pick up this year, or do you think some of these consumer headwinds you were talking about and maybe business headwinds could put sort of a cap on that?
No, we do foresee loan growth accelerating, during the course of the year. I think, and you kind of alluded to the questions around tariffs and immigration, and what the interest rate backdrop looks like. I think as we kind of get further into the new administration and get answers to some of these questions, I think corporates will be more willing to borrow and put money to work. So, after a period of subdued loan growth, we do see an acceleration of commercial loan growth as the year progresses. And on the consumer side, you have seen credit card growth has been fairly active. The consumer continues to spend, and I think as long as the unemployment remains in the low fours, you could see continued activity there as well.
Jason, always good to see you. Always good to have you on the show. Thanks for joining us.
Thank you.
All right, now let's get to our call of the day. Deutsche Bank upgrading General Motors from hold to buy. The note highlighting that Trump-related risks are already priced into the stock. It's a fun note. Deutsche Bank does upgrade GM to buy. Target goes to 60. Sees the company reporting the high end of its guidance range in the fourth quarter. Analysts talking about moves they've been making in China and cruise. They talk about its track record of execution, aggressive share buyback trajectory. And yes, they say there are risks from Trump 2.0, but they think they're telling clients those are well known at this point, room for positive surprises.
Yeah, and by the way, the company reports on January 28th before the bell. That's when they're due to give the earnings. The shares are up more than 50% over the past year, so they've already done quite well in this environment. But yeah, there's all the reasons that you were just talking about here. One of the other things that they say might mitigate some of the EV-related uncertainty, they say this, Edison Yu, the analyst there, says the strategy is not entirely dependent on volume, but also on battery and materials cost savings, as well as emissions credits. Now, will those emissions credits go away in the market? I guess we'll have to kind of see how that part shakes out. But he says it won't be, it'll be cushioned a little bit.
They also know the outperformance against Ford in the past year, telling clients they see 2025 being directionally similar. Yeah. All week, Yahoo Finance is bringing you conversations from the World Economic Forum in Davos. Earlier, our executive editor, Brian Sozzi, sat down with BNY Mellon CEO Robin Vince.
Leaders of the world's biggest banks have descended to Davos, Switzerland for the latest World Economic Forum. Let's bring in one of those leaders of the world's biggest banks. That's BNY CEO Robin Vince. Robin, good to see you here. Appreciate it.
Great to be with you, Brian.
Look, I think we're taking a lot of information from the new Trump administration. From a banking CEO perspective, what are you most optimistic about? Because we've seen a big run in financial stocks. A lot of optimism is priced in. What are you hopeful that this administration gets done?
I think it's terrific and this isn't just in the US, we're seeing this from other governments around the world as well, but to see a government that's really focused on growth and being able to make the economy everything that it can be. Because ultimately, as one of America's leading banks, we're focused on helping our customers to be able to grow and thrive. That's what our platforms are all about. We provide platforms to really help clients navigate capital markets and the financial world broadly. And I was in Japan a couple of months ago, and you can hear the story from them as well. They'd like to try to recapture growth. They haven't had much for 30 years. Here in Europe, they've got real growth challenges. The UK government from just 6 months ago, they haven't made their progress yet. These things take time, but they've put that at the top of their agenda. And so hearing from the Trump administration that is really their number one goal, I think it's a great time and moment for businesses to be able to partner with government, help make all of that try to come true.
I talked to your counterpart at Bank of America, Brian Moynihan. He struck an optimistic tone on what the administration might do on the Basel III endgame. Long story short, might roll that back. More capital could be returned to shareholders in various forms. Are you hopeful that program gets rolled back, and what does it mean to a company like BNY?
Look, I'm more focused on having a stable, level playing field. I think the lesson that we've learned over the past 15 years is banks have added a lot of capital, banks have added liquidity, the regulators have done a terrific job making the system stronger. Now we have a strong system. Let's go out and use it for the very purpose for which banks are created, which is to be able to help grow and help clients and individuals be able to be successful. And so we've got to be able to put that capital to work. Will we return things to shareholders if we need to? Sure. But would I prefer to be putting it to work in the business? Absolutely.
Are you concerned that we go back to 2006, 2007, things just get too loose and there's too much risk in the system?
I actually am not that concerned about it. We have to be vigilant that that doesn't happen. We need a strong, healthy financial system. We're one of America's largest banks, and we've seen how the strong banks have been able to actually help the system over the course of the events through COVID, through what happened with some of those regional banks a couple of years ago. We've been a force for strength in the economy, and that's actually the role that we should be playing. I'm not worried about the return. I'm looking forward. I'm thinking about the innovation. I'm thinking about the investment. I'm thinking about helping to make economies grow and our clients be successful.
Does looser regulation, potential looser regulation on banks this year, does it mean, can you draw a straight line to more M&A activity, higher capital markets business? Is that how investors should be thinking about what may come from the big banks this year?
I think it's about safe and predictable from a level playing field point of view for regulation. Like that, declare victory. The work has been done. Banks have been invested in sort of the safety. That's terrific. But now we've got to look forward. And so is M&A possible? Absolutely. That's a healthy, thriving capital market, includes M&A. But what matters more than anything else is that we're able to help our clients be able to grow. You know, it's our clients who want to be able to participate more. They want to be able to invest more. They want to be able to borrow more. We're a capital markets organization. So when capital markets grow, BNY can thrive.
There's a consensus forming, at least amongst the folks that I have talked to here, tariffs equal inflation. Are you on board with that? Because I think it would have direct implications for what the Federal Reserve may do next on rates.
I think it's more complicated than that. Tariffs are and always have been a tool of trade policy, and the president's made it very clear that he wants them to be used as part of trade policy. And I think if you put tariffs on top of everyday items that Americans are consuming, that they go to their local store, grocery store, or home goods store and buy, they can be inflationary. But at the same time, tariffs well applied can also make US businesses more competitive. And so we'll have to see how all of that unfolds, but I think it's how they're used that's going to determine the answer to that question.
In that type of environment, can you rule out a rate hike from the Fed this year?
I don't think anybody should rule out anything.
Yeah, especially in this environment, right?
Of course. And we're risk managers. It's our job to be prepared. It's our job to be agile. We've seen administrations since before the founding of the nation. Our first administration was George Washington's administration. And so you've got to be able to work with Congress, with the incoming administration, with regulators, and you've got to be able to adjust. And the same thing's true on rate policy. Do I sit here right now expecting the Fed to hike? I don't. Is it possible? Of course, anything's possible. Do I think they're on pause? Probably for a little while. Let's see how the inflation plays out. They've been on a medium-term track, getting it in the right direction. Does it need a couple more rate cuts? We'll have to see over the course of the year. But overall, I think the Fed's done a terrific job these past 2 years in terms of being able to kind of grapple with the issue and have an economy that's actually thrived through it. Remember, that was not our expectation 2 years ago, that they could go through a rate hiking cycle and be able to have the type of thriving economy that we've actually enjoyed over the course of the past couple of years. But they have to finish the job on inflation.
Lastly, I remember I was talking on my Opening Big podcast about crypto. You sounded optimistic about crypto when we talked. Are you more optimistic now based on who the Trump administration is? We may have a crypto czar now. We seem like crypto regulations will be looser. And does BNY want to play a role in the community?
Well, we've said this for the past couple of years, and we've been consistent, and we haven't changed our point of view on this, which is digital assets represent a new, interesting, innovative technology, which we think could be important to the financial system over the course of the next 10, 20 years. Exactly the twists and turns along the way, we'll have to see. But we've been investing. We've got the ability to custody crypto assets, digital assets, but also we're looking into the interesting smart contracts, ledger capabilities that the underlying technologies represent. And so we think there's an interesting future here, but AI as well. Remember, it's not just about digital assets. It's about how does technology get applied to make the financial system better, more agile, more capable, and able to grow. And AI is going to be an important part of that story too.
So true. All right, we'll leave it there. BNY CEO Robin Vince, always good to see you. Good luck with the rest of WEF. Appreciate it.
Likewise. Thanks,
Thank
Brian.
you. Appreciate it.
Apple being hit with multiple downgrades today from Jefferies and Loop Capital is coming as the company continues to struggle with iPhone sales in China. For more, we're bringing in Ben Baharin, CEO and Principal Analyst at Creative Strategies. Ben, always good to see you. So we have some analysts, Ben, they're reconsidering their opinions on Apple. One common theme, Ben, seems to be China, right? This idea that China is weak. And I'm curious to start there, Ben. What are you seeing and expecting in China when it comes to Apple?
Yeah, I mean, I think you're right. The challenge is really local competition that's been coming up. I think that's kind of been the noise that we've heard. We know that Apple has generally dominated the premium price tier in China. I don't think that's really under threat. I think that whole market segment is facing increased competition, right? You've heard a number of the Android OEMs talk about increasing ASPs for their products, both Qualcomm, MediaTek sort of saying the same thing. So we know those vendors, we know Huawei is now back in the mix. Obviously that plays into the factor. So I think it's worth keeping an eye on. I think it's really hard to monitor China. You talk to a lot of the firms that count those units, you see a lot of inconsistency. So I think we need to hear when those numbers come up. I think I think Apple continues to hold well there. I think the challenge is there a lot of growth left for them? I think that's really going to be the conversation broadly. But yeah, I think the increased threat is there. However, though, we've said this for really the last couple of years, that there's an increasing threat and their numbers have been relatively stable. So I think it's still a wait and see, but those dynamics are still risk factors.
And then, Ben, it seems like one of the other big issues is Apple Intelligence and the appeal or lack thereof, or at least as something that is going to drive, to your point, any uptick in growth versus just sort of maintaining the status quo. What do you think the reception has been like, whether you're talking about here or in other areas of the world?
Yeah, I mean, my point of view continues to be that consumer AI is still a really immature market. I think we're still very early days. Everybody is struggling to create some value propositions there. I do believe that story will get more interesting over time. I just don't think it's quite there yet. I think the dynamic with Apple, though, I keep coming back to is, just on the basis of just the annual upgrade cycles that they have within their very large base, 1 billion plus consumers with iPhones, they see steadiness, right? You look at what people are forecasting for their growth, and it might be a couple points a quarter, but it's not 20, 30% anymore, right? We're looking at percentage points, single digit percentage points, and it's really just at what part of the year do people upgrade. So I don't think anybody thinks, iPhone sales drop off a cliff. I think it's just a matter of, how do we see this upgrade cycle get spread out, and when might there be a consumer lift for AI? Because it's not yet. It's been my conviction. I do hope it happens, but I don't see anything yet that moves the needle for them or really anybody else that's going to be pushing, kind of more AI features in smartphones anytime soon.
Ben, I've heard some Apple bulls make the case. They'll say, okay, China could be relatively weak, but what they'll point to is they'll say emerging markets for Apple really strong, and that could help offset any kind of weakness we see in China. What do you make of that argument?
Yeah, I think the emerging market story is an interesting one. It's just, again, it's not going to be the highest ASPs. We've talked about India before as a market. It's certainly an opportunity as some of that market moves upstream, very similar to China did, but really not at the same volumes. That's still a little bit of a price-sensitive market. And you see this with other parts of Asia, where it's really the true, reality that they've got price bands there where kind of like entry-level iPhone, or obviously, what Apple's done with the iPhone SE in the past is designed to appeal to some of those more price-sensitive customers. So I still think that's a good story. Again, though, I don't think we can use that as a basis to say it's going to be back to double-digit growth anytime soon. I think, again, you need to see a hardware cycle really kick in for people to start to get really excited again. Now, again, with some of these markets, and China's one of them, we don't know what Apple Intelligence will do there. Maybe it's more interesting. I've heard many times that the China market is farther along than the U.S. consumer or other parts of Europe consumer regarding AI. Apple Intelligence isn't there yet. Maybe once it is, that helps some push. But right now, right, it's just you're not seeing that really drive any more demand, and really just what we're seeing is the continual upgrade cycle of their large base getting older and needing new devices.
Ben, always great to see and have you on the show. Thanks for joining us.
My pleasure. Thanks for having me. Good to see you, Josh.
And while we're wrapping up today's market domination, don't go anywhere. We've got you covered with a jam-packed hour following the closing bell. On the other side of the break, it's the latest earnings reports from Netflix and United Airlines. We're going to get you those numbers as soon as they cross the wire. Stay tuned for Market Domination Overtime.
There's the closing bell on Wall Street, and now it is Market Domination Overtime, sponsored by Tasty Trade. We're going to be joined by Jared Vlickry in a moment to catch up to speed on the action from today's session. If we look at where stocks ended the day, we had a rally all across the board, and finishing pretty much at the highs of the session, with the Dow up 538 points, 1.25%. The S&P 500 up about 0.9, and the Nasdaq up about 0.2%. And Jared, it seemed like relief about tariffs seemed to be the name of the game.
Yes, that was a big driver of the dollar's decline yesterday, and we got some more news overnight. We'll get to the dollar in a second. Just want to point out that, yes, the Dow is up over 500 points today, but the Russell 2000 beat the majors. It was up almost 2%. And let's go to, I believe this is going to be the 10-year first, and then we'll go to the dollar. Never mind, we'll take the dollar here. This red candle, this big red candle is what happened yesterday. That's when Trump did not mention tariffs in his big speech yesterday. Then today we got a rally. It's hard to see on this chart. We got basically to the halfway back point. That's a 50% retracement. Then we closed at today's lows. Very important, because we have seen this trend of the higher dollar. This is a one-year chart. I'll put some lines on there so you can see it better. This is what's happened since basically October, and that includes the election, which happened right here. And we are off of these highs. Very important. 110 was causing a lot of problems for risk markets. We're going to get into that with Josh in a little bit. Here is the 10-year T-note yield. That was down 3 basis points today after a bit of a collide. I don't think it was actually open yesterday. We might have had the futures open, so I'll take that back. And then Bitcoin up to 106,000. It looked like it was having a nasty sell-off reaction after breaking to new highs yesterday, but now it is back very close to record highs. So a big, broad-based risk rally is what we are seeing today. And you can see that in the sector action. Only energy was down today. It was down by about 0.5%, as you can see here. Industrials took the cake, then real estate, then healthcare, then utilities. So that's kind of a defensive setup, at least interest rate sensitive if you think about it, except for industrials. Then we get into some more cyclicals with materials. And then down the line, we got communication services. That wraps up the outperformers. And like I said, a pretty broad-based risk-on rally, guys.
Thanks so much, Jared. Turning now to shares of Netflix, the streaming giant reporting fourth quarter results, and the shares are surging 10.5%. The company's numbers beating pretty much across the board and in terms of forecasts. So let's go through them. Fourth quarter earnings per share, $4.27, $4.18 is what analysts had been anticipating there, and revenue at $10.25 billion. That too was ahead of estimates. The company is also coming out with forecasts for the first quarter revenue, which looks like it might be a little shy actually, as well as earnings per share. First quarter revenue at $10.42 billion. That's the forecast. Analysts estimating $10.48 billion, and earnings per share in the first quarter seen at $5.58, $6.01 is what analysts had been anticipating. However, for the full year, Netflix says for 2025, revenue will rise 12 to 14%. The midpoint of that above the forecast, and the company also raising its forecast for operating margin for the full year. So that seems to be mitigating any negativity around that first quarter forecast. Also, we got a buyback authorization of an additional $15 billion. So put all that together and you get a 10% gain in this.
And of course, what's impressive here is this stock had already surged. It was up about 80% over the past 12 months heading into this report. Now it's jumping about 10% in the after hours here. I know some questions, front and center for analysts on the street, kind of broader questions for them is this company has talked very confidently about their 2025 content slate. Very obviously confident about what's coming. So I know the street's going to be here to hear, okay, what do you think that actually mean in terms of impact on net ads and your financials? The strategy when it comes to live sports is going to be talked about a lot on the call. What did execs learn from those NFL games that were streaming over Christmas? Then also, of course, front and center for investors, how does the ad tier change? How does it evolve over here as they continue to keep adding these events?
Yeah, and I'm just scanning through the shareholder letter here, which always has lots of good tidbits in it. They're touting some of the programming that has come out, including, of course, sports. They talk about the Jake Paul versus Mike Tyson fight, even though it had some technical glitches. Still was what they said was the most streamed sporting event ever. Christmas Day, they had those 2 NFL games that were also heavily streamed. And then, of course, they talk about Squid Game Season 2. Carry On, which was that movie, TSA-themed thriller, which also did well for them. I mean, whenever we say did well, it didn't mean as much, but now that you have ad dollars also that are following some of that, there's a little bit of a different nuance when they talk about highly rated shows.
Yep. All right, let's get more insight and instant analysis on this one. It's more on Netflix's fiscal fourth quarter, the streaming space. We have Manhattan Venture Partners Head of Research, Santosh Rao. Santosh, good to see you. So listen, let's get your immediate reaction to this report. Investors clearly like what they see here, Santosh. We're up about 10% in the after hours, but give us your reaction. What do you make of the print?
Absolutely. The headline is very good. The numbers are good. They beat on both the top and the bottom line. The guidance is also okay. I think it's more a profitability story going forward. The subscriber, they're going to stop reporting subscribers. But I do want to know how they did the subscriber count in 4Q, because they had these big events. And if they show the huge numbers that we all know that came in, and that's a good sign. That means they can do that. That's a big catalyst going forward as they move to more and more live sports, because that's the biggest trigger for the media companies. That is where the real action is. And if they can show that here, we can be sure that they will go on, even though they won't report it. I'm sure it will show up in the revenue numbers and the profitability numbers down the road. So net at at first blush, I would say it's a good number.
And I am seeing that they did see a streaming paid memberships number before they stopped reporting it of 301.6 million, which was up 16% year over year. So that was what we heard from them for the fourth quarter, Santosh. So if it is a profitability story, what do you want to hear from the company going forward? I mean, are you encouraged, for example, by the fact that they did raise that operating margin forecast for the full year to 29%?
That's a very good sign, because, live sports are expensive, and that was a big concern. How are they going to pay for it? Will the ad revenue make up for all the expenses up front? And I believe it will down the road. It's a good investment. So it was important to see where the margins, they raised their operating margin, which is great. That's what we want to see. So, I mean, it's been very sensible growth. They have a strong slate, and and good management of costs and everything. So I think that's a good formula going forward. Good slate, good content, good profitability, and just managing and bringing in more and more subscribers based on this new content. So I think that's what people want to hear. That's what people. The churn is a big factor in this business, and if they can show that people are coming in, they're staying, and that's a great sign, because that's what they want.
Santosh, how do you see the ad tier specifically evolving from here, especially as they continue to keep adding these live events, Santosh?
Yeah, I think the ad tier will keep on growing. We saw a lot of additions. Let's see what the actual number was. But people are moving more and more to the ad tier, which is great. I mean, ad tier is not very profitable. At some point, I think the new markets that they will roll out in are not very high in average revenue per user, the ARPU number. But even then, there's going to be volume in there. So ad tier is not going to be a growth engine like they said, but it's going to pull in a lot of people. It's going to keep people there. And over time, I expect them to raise prices. That's for sure, because they need to pay for all these expenses. And if you have good content, I'm sure people won't mind paying extra few bucks for ads. So I think that's what's happening. You will see a lot of people coming in. Ad tier will do well. It's going to be their growth engine for the next few years, and probably even surpass the other the paid subscription model as well. The other one, the premium model. So there are a lot of expectations. I think it's on the right track. I think that's what I expect that to happen.
It's interesting, Santosh. I feel like this is a common refrain from the company, that they talk about penetration globally, right? And they say in their shareholder level, we believe we account for less than 10% of TV viewing in every country in which we operate. If that includes the U.S., I guess that would surprise me. But I guess the point is, they had experienced that big international growth that sort of picked up as growth in the U.S. slowed down. How much volume growth do you think internationally they still have ahead of them?
Yeah, I think it's still a long runway ahead, because It's a global market. They are going to add a lot of content, and a lot of these, in fact, in many countries, this is the only game in town, or it's the best game in town. So they're going to pull a lot of people in. So there's no question about it. Yes, there is a limit to how there are. It's a law of large numbers. At some point, they're going to hit. It's going to slow down. The rate of growth is going to slow down, but there is still more. You're going to see a lot of people move away from linear TV. That's happening for a long time. They're all coming into the streaming side. So there's a long runway there as well. So yes, it's not going to be as fast as it happened in the past, but yes, there's long runway ahead in terms of converting people to streaming and adding them to your platform. And their big part is that they have in multi-languages all over the world, strong presence, strong mind share, strong market share, and that's going to pull more and more people into their ecosystem. And that's key. That's what you want.
Santosh, instant analysis, very helpful, appreciate it. And I should mention, per Santosh's comment there on pricing, the company says it is adjusting prices today across most plants in the US, Canada, Portugal, and Argentina. But they said that was already factored into their guidance that they had provided late last year. So we'll see if there is even more pricing to come. Thank you, Santosh.
Yep. Thank you.
All right, shares of United Airlines, they're higher following their fourth quarter earnings report. Let's get you those numbers. Q4 adjusted EPS, 326 versus 305. That's a beat. Operating revenue, 14.7 billion. Street was closer to 14.35. That's a beat. Looking ahead, Q1 EPS, they're calling for between 75 cents to $1.25. The Street was at 56. And 2025 adjusted EPS, they're looking for 11.50 to 13.50 versus the Street's outlook at 12.84. This one, Julie, we had talked about this. It was already a rocket ship over the past 12 months, and you're down about 4% again in the after hours.
Yeah, total revenue per available seat mile going up 1.6% year over year, and cost per available seat mile down 1.6%. So that's something to keep an eye on here. Capacity also rising by 6.2%, but it seems like, capacity growth is always a bit of a tricky thing with the airlines. It seems like the demand is there to meet that capacity growth. So watching that, the company in its release highlighting that it set the company record for most customers carried in a year, almost 174 million across their system, flying on United flights. This, I think there is a read-through here for United specifically and its operations. There's also something of a read-through for where we are in this travel boom that it does not seem to be
Demand
showing
is still
much,
there.
Yeah,
Folks are still flying. And to that point, here's CEO Scott Kirby saying 2024, he says, strong year across the board for United. We've become the leading global airline. Then he says, as we enter 2025, demand trends continuing to accelerate, which puts us on the path to double-digit pre-tax margins, and you can see the reaction this time.
Well, and listen, anecdotally, anyone who has purchased a flight, you and I have been talking about this anecdotally, and anyone who has purchased a flight in the last 3 to 6 months, you've seen very up close and personal how these airlines are doing so well.
Yeah.
They are charging.
Let me tell you, the first thing I'll tell you, you want to go to California? You better want it. You really got to want it, I'll tell you. All right, let's get back over to Davos. Our very own Brian Sazi caught up with Coinbase CEO Brian Armstrong to talk about the cryptocurrency landscape under President Donald Trump.
All right, I'm here with Coinbase CEO Brian Armstrong. Brian, you're a busy guy. I mean, thanks for giving us a few minutes. We appreciate it.
Of course.
So you've had the great opportunity of meeting twice with President Trump. You met him before the election, you met him after. How serious is he about a strategic Bitcoin reserve?
Well, I didn't talk to him about that specifically, but I think he is excited about it. I mean, he really wants to be the first Bitcoin president. Cynthia Lummis in the Senate is actually, I think, the one driving this legislation around a strategic Bitcoin reserve, and I think it's a good idea. The U.S. actually has reserves in lots of things, gold, oil, I think like 27 different rare minerals like palladium and all these things. And so, I think the world is moving to a Bitcoin standard for money. They absolutely should hold. Any government who holds gold should also hold Bitcoin as reserve.
I'm sure we could do a 2-hour podcast on the mechanics of a Bitcoin reserve, but for the average folks out there trading crypto, what does that look like? And is there a probability that you could place on this actually happening?
Well, I think for the average person in Bitcoin, I mean, if the US gets a strategic Bitcoin reserve, probably the rest of the G20 will follow, or many of them. And that's just, that's going to drive the Bitcoin prices way up. So there's a lot of positive drivers of that. I think we have an opportunity to get regulatory clarity in this new administration. The Bitcoin ETFs are seeing record adoption. They've kind of broken all the records for ETF inflows. We're seeing payments really start to take off with stablecoins. It grew 300% year over year. Did about $30 trillion of payment stablecoin volume last year. So it's pretty exciting, and I think that this is all like just positive news for Bitcoin adoption.
I remember I last talked to you, or I caught up with you at the Goldman conference in 2023, and you still saw Bitcoin prices going to a couple million. But I mean, fast forward today, I mean, there's a lot more, I guess things are about to loosen up regulation-wise. You still, I mean, do you see higher prices than that?
Well, I think you say loosen up regulation-wise. We actually, well, it's a strange thing because we actually don't think there was much clarity in a lot of the rules over the last 4 years, which was actually weaponized by the Biden administration and Gary Gensler, who's really attacked the industry. We actually have been calling and petitioning for more clear rules. So in some ways, we actually want to be regulated even more. And that's what's going to allow trust to exist in the system, consumers to be protected, and more capital to flow in. And the good news is that in this new administration, the Trump administration, I think he's really pushing every department in the government in the US to move toward getting regulatory clarity.
And of course, lastly, I encourage everyone to check out Brian's blog. Just dropped it on economic prosperity. Last one for you, Brian. What made you write that? And what is, how does crypto tie into economic prosperity?
Yeah, well, the mission of Coinbase is actually to increase economic freedom in the world. A lot of people don't know exactly what that is. There's many types of freedom of speech and assembly and religion. Economic freedom is one of these foundational principles, which is really that can you actually keep what belongs to you? Can you benefit, if you're going to work really hard, try to do something good for the world, can you keep the upside of your labor? Or is your wealth being eroded through inflation or confiscation or corruption and bribery, or being debanked in many cases, which actually happened in the US and Canada. And so we believe that crypto is this unique technology that can actually enable economic freedom in countries all over the world. It's returning the world to sound money. It's creating property rights for anybody, which means if you have a self-custodial wallet, you can remember the passphrase to it. You can take your wealth with you, even if the government wants to take it, or if you need to go to cross-border, or you're a Syrian refugee. And so it's, crypto is really fundamental to having more economic freedom, and we think that that is foundational to all prosperity.
All right, we'll let you get to your fireside chat here at the World Economic Forum. You're an in-demand guy. Appreciate you making some time for us.
Thank you.
Thank you, appreciate it.
Our coverage from Davos at the World Economic Forum continues. I'm joined by Harvard economist Ken Rogoff. Professor Rogoff, thank you so much for joining me.
Thank you for having me.
Donald Trump has just taken office for the second time. Given the policies that he has laid out, from tariffs to tax cuts, mass deportations to regulation, what do you think the economy will look like under his leadership?
I don't think we're going to see the boom that we saw in the first time, partly because back then, zero interest rates, there was a lot of room to borrow money. The economy was still recovering from COVID. This time we've had a boom, a debt-fueled, migration-fueled boom going on for quite a while. And even if he didn't do anything, eventually we would run into some slowdown, not necessarily around the corner. And a lot of his policies are sort of geared towards extending that, putting more fuel on the fire, so to speak, in an already very strong economy that, if anything's overheated. The deportation, let's just set that aside. I don't believe that's going to happen. There'll be symbolic deportation. I don't think that's going to have a big effect, but what will have a big effect is not having the mass immigration. I think the open border policies was nuts. It was immigration, legal immigration, good, illegal immigration, bad. But near term, it was one of the factors, as Powell said and others, pushing up the economy, along with this massive string of deficits that he ran. So Trump, if he just keeps doing that, the inflation, either the inflation will come or interest rates will have to be even higher than they are now.
I want to unpack that a lot more. First, you said you don't think we're going to see the economic boom, and let's set immigration aside. Does that mean we just see tepid growth, or do you see a prospect for slow growth to perhaps recession?
So I think the most likely scenario, with what I think are the most likely policies being passed, are strong and then a slowdown in at least by a slowdown into recession the second half of his term. It's just tough within the cycle not to do that, and also when you goose up the economy with these policies, most of which are not structural, they're really demand policies, you're going to get that effect. And by the way, I'd say the same thing with deregulation, which I applaud, but some of the deregulation, particularly in the financial sector, is probably going to lead to trouble down the road.
On the tariffs, we don't know the exact form that those are going to take, whether we're going to see more targeted versus blanketed. I wonder, some economists see them as inflationary. Others say that if we were to see blanketed tariffs, that could really cause growth to plunge and offset any inflationary impact. How do you see them?
The inflationary impact is not a big deal quantitatively, 1%, 1.5%, even with a very large across-the-board tariff that he's talking about. But it wouldn't last that long. I actually think normally the Fed would ignore that. More worrisome is that it's chaotic. It hurts these animal spirits that he's been benefiting from. It actually leads to slower growth. That happened, or was threatening to happen, when he raised tariffs in 2018. They were raising rates from 0, as you recall. And then when the tariffs hit, there was so much uncertainty, so much nervousness in the business community, they cut interest rates. So it's so hard to predict anything from Trump. Particularly, I don't think he knows what he's going to do. He's sort of winging it.
You mentioned the Fed. They penciled in 2 rate cuts for this year. Do you think they carry those out? Where do you see the path for policy?
I don't think they carry them out. I mean, I think the odds of a hike are the same as the odds of a cut. I think, with running these deficits and continuing the economy, looks strong in many ways. There's a lot of investment going on in data centers and such with AI. That whole notion that the Fed seemed to have that the neutral interest rate was just really low, they can throw that out the window. I think that's not in our future in a recession. But even in a recession, don't expect 0 interest rates again. I think even in a recession, interest rates will stay higher than we've gotten used to.
Trump has pledged, as we talked about, to scale back regulations. And on a banking panel this morning, we were hearing from bankers here in Davos that they are excited about the potential for deregulation for the banking sector and the growth that could unleash. I'm curious, though, when that happens, does that create vulnerabilities within the financial sector? What are your thoughts on that, and where do you see vulnerabilities now for perhaps future financial crises?
Well, I mean, there's good regulation and not good regulation, but what happened with some of the very small and medium-sized banks getting into trouble not so long ago, that was a result of deregulation that happened under Trump, where he put weaker restrictions on the medium-sized banks, and a lot of them are still in trouble. Interest rates have not come down. They're carrying debt on their books. The Fed is having to roll over a lot of its loans. It's not that we have this super strong banking sector. So I think if you deregulate too much in the banking sector, it's going to lead to a problem. Maybe the Fed will bail out even bigger than ever before. And then I would say that times 10 with crypto, where it has way less regulation than it needs, and we're talking about taking that away. So deregulation, in general, the general principle, the thrust of the Trump presidency, less regulation. Biden was overdoing it in many areas. I'm very sympathetic to. But I think finance is one where you have to tread a bit carefully.
15 seconds. You think Trump will get the weaker dollar that he wants?
I think Trump's going to get a weaker dollar whether he wants it or not. The dollar is very high. It's only been this high twice over the last 40 years. 1985, 2002. It's come down over the ensuing year or two. I have some conviction that that's going to happen again over the next year or two.
Professor Rogoff, thank you so much for your insight. I so appreciate it.
Time now for What to Watch Wednesday, January 22nd, sponsored by Tasty Trade. We're going to start off on the earnings front. We're getting some more bank earnings. Ally and Discovery. Discovery announced results for the fourth quarter after the closing bell. Analysts expecting credit losses to remain elevated for the quarter, and investors will be looking for any commentary on the final stages of the bank's sale to Capital One.
Sticking with earnings, more corporate numbers coming in throughout the day, including Procter & Gamble, GE Vernova, and Johnson & Johnson. Procter & Gamble announcing results for its second quarter before the opening bell. Analysts there expect organic sales will gain for the quarter, but recent declines in China and the threat of tariffs will have investors listening closely to the company's guidance.
And moving over to housing, we're going to be getting weekly mortgage application data. Last week, mortgage applications jumped up more than 33%, giving us a pulse on demand and affordability trends in the housing market.
And all week long, Yahoo Finance is bringing you conversations from the World Economic Forum in Davos that could get you back out to Brian Sozzi and Jennifer Schonberger for what investors need to be watching from the landmark event this week.
Yahoo Finance continuing its coverage at the World Economic Forum in Davos, Switzerland. I'm Brian Sozzi.
And I'm Jennifer Schonberger.
All right, here are a couple top takeaways from the conference so far. For me, Jen, it is two things. Had a great chat with Bank of America CEO and Chair Brian Moynihan, telling me that the Federal Reserve may have to keep rates higher for longer as the Trump administration eyes potential tariffs. So that's number one for me. And one was interesting because I do enjoy me a good glass of whiskey. Suntory CEO Tak Niyanami telling me they have stockpiled 1 year of whiskey in Europe ahead of potential Trump tariffs. 1 year, not 6 months, not 2 quarters,
wow.
A whole year of whiskey. That's a lot of aging there, Jen.
That is a lot of aging, but it tells you what they're trying to get ready for. I think what's really struck me is the dichotomy between different voices. On the one hand, these banks seem so euphoric about Trump coming in, the golden age is here, a lighter regulatory touch is going to unleash lending and an economic boom. On the other hand, I talked to other economists like Ken Rogoff from Harvard University, and he thinks that maybe the first half of Trump's administration will look good, but the second half, growth will actually tail off. So I think there's a lot of uncertainties now. Of course, we don't know what these actual tariffs are going to look like. And already global leaders are getting in front of it, striking conciliatory tones in the hopes of trying to negotiate with this new administration. Both Europe and China saying that the time now is to create a stable environment. We want to negotiate. We want to talk. A very conciliatory tone.
Yeah, I heard a lot of optimism, too, from Brian Moynihan, but also Robin Vince, BNY CEO. But I think they have to remember, and even investors have to remember this too, Jen. Sure, we have seen a major rally post-election in these financial stocks, really across the board. But regulations, especially in banking, you cover this, they don't change overnight. Right. It's not like day one of the Trump presidency, we're going to get a major rollback in regulations and suddenly first and second quarter earnings for banks are going to explode. It doesn't work that way. Government doesn't work that way.
But the animal spirits are alive, and that is what's driving everything right now.
All right, good stuff. All right, be sure to tune in for more of Yahoo Finance's World Economic Forum coverage from Davos, Switzerland all week.
Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. The first full day of the second Trump presidency has been a good one for the markets. The Dow, the Nasdaq, the S&P all finishing comfortably in the green. We're going to dive into the rest of today's market trends straight ahead. Then tech execs were front and center at Donald Trump's second inauguration. So what does this unusual relationship mean for the industry moving forward? Plus, we're going to travel to the World Economic Forum in Davos, Switzerland, to hear from the CEO of Suntory Holdings about the impact new tariffs could have on the alcohol industry. Well, prominent tech leaders attending President Trump's inauguration, highlighting the unusual dynamic between tech execs and the new administration. Elon Musk, Mark Zuckerberg, Jeff Bezos, Sundar Pichai, all seated on the inaugural platform alongside Trump's cabinet appointees. But what does this bold messaging mean for the big tech players? Let's get to Kristof and Company CEO Nikki Kristof. Nikki, it is good to see you. So let's talk about this relationship, Nikki, between Trump and big tech. Because certainly, listen, at the inauguration, big tech, they were out in force. The CEOs were there. The heavyweights were there. It was a big show. At the same time, Nikki, we know when Trump talks about big tech, it isn't often very nice, Nikki. It's sort of the opposite of nice. So I am just curious how you actually see this relationship between Trump and big tech actually evolving now over the next few years.
Well, thanks so much for having me. You make an excellent point. President Trump often delineates between big tech and what he calls little tech. And he certainly has been no friend of big tech or the consolidation of power. We did, as you said, we saw yesterday a sort of stellar lineup of the biggest names in tech at this inauguration. And I think it was less about what those leaders are communicating to the president, maybe more about what he's communicating to everyone watching, to all of us. In 2017, he could not get them to come to his inauguration, even if he had asked. And we saw a complete about face on that issue yesterday.
And what do you chalk that up to, Nikki? Is that because the win was just, listen, it was decisive this time? You know, unlike 2016, I mean, he won. He won the electoral vote. He won the popular vote. Is that what you chalk it up to?
I actually don't chalk it up to a mandate. I would say that the leaders that we saw are across a spectrum of enthusiasm and attitudes toward this new administration. You have everyone from Elon Musk, who is reveling in the win and taking some credit for it, to Mark Zuckerberg, who always seems somewhat reluctant to moderate his platforms, who seems a little bit eager to embrace a cultural shift, to Jeff Bezos, who has always been a pragmatist and is interested in space exploration, to Tim Cook and Sundar Pichai, who, you know, if I were a betting woman, I don't know that they'd want to be there necessarily, but it is their job to be there. So I don't think we should lump all of these CEOs into one category of fealty. I don't think that's at all what we saw.
Do you think, you know, I get, of course, Nikki, why these CEOs want to get close to Trump. They want to stay on his good side. They want to have an impact in terms of how he thinks about all kinds of issues, from AI to regulations, you know, antitrust enforcement. At the same time, you know, they go back to Silicon Valley. They got a lot of employees. They're not fans of Trump. Do you feel like maybe tech CEOs have a finer line to walk here, have a tougher balancing act than maybe CEOs in other sectors, other industries?
Well, as someone who worked in Silicon Valley at Google's headquarters for 6 years and has worked at Uber and Salesforce, I can tell you that tension between any Republican administration or Republican, you know, congressional office and the vast majority of tech employees has existed for, you know, the 17 years I've been in the industry. I do think, however, we're seeing workers somewhat gutted. And so from DEI policies to just the market for jobs, it's not the era that it once was, where they could make demands of political outcomes of their leaders. So I think that it's getting a little easier to navigate, which is they have businesses to run and they're going to run those businesses.
In terms of policy, Nikki, do you think investors who are listening right now, should they expect, for example, more M&A activity for the tech sector with Trump 2.0? Would you expect to see a pickup there? I was talking to another policy analyst and I asked him that question. He said, well, he kind of painted a fine line there. He said, I would expect that, he said, For small cap tech, I think consolidation can get greenlit there. I don't think you're going to see that for big cap tech. He thought, listen, on antitrust enforcement, I guess his point was he thinks Trump and Biden are maybe closer than a lot of people think or expect, but interested to hear your take.
Well, I think there's a tectonic shift over at the FTC. We are no longer going to be in the era of Lena Khan, who's been very anti-tech. In fact, she's gone to Europe and called on them to have more regulation over our own American tech companies. So there's certainly a personnel shift that's going to have an impact on policy, but you're absolutely right. The Biden administration and the Trump administration are concerned with over-concentrations of power among just a few companies. So I don't know that we see a lot of big M&A. I think we're more likely from an investor standpoint to see more IPOs as the markets kind of break open, as capital rushes in, as we have an energy abundance policy that is clearly a priority for this administration. But I don't think we see a lot of mergers with big tech companies.
One final question, Nikki. I'd be remiss if I didn't ask you. We're talking tech here. Any thoughts about the TikTok drama, Nikki, and how you think this actually plays out?
I had said that I thought the Supreme Court would uphold the law. They did. I expected a 90-day pause. President Trump only signed a 75-day pause. He had a really interesting idea, so we can end on that, a joint venture arrangement where you would have an American company and a Chinese company working together with joint ownership. It's interesting because China mandates that structure for all American companies that are operating there. So if you want to be in China, whether you're an automaker or a tech company, you must be aligned with a local Chinese company. So I think it's interesting. He wants to see if they're willing to take a dose of their own medicine.
Final question, Nikki. We've talked about all these big players. Would you break it down in terms of potential, to put it kind of crudely but broadly, winners and losers in big tech?
Yeah, losers, electric vehicles. And I don't know what that means for Elon Musk, who still seems, as I said, to be reveling in this win. But the rollback of the electric vehicle mandate is a real problem for that part of the industry. Big winners, I think certainly crypto came out a big winner. They have a new SEC. I think AI is a winner. They had a rollback of that policy. And I think a sleeper winner is cloud services and government, Oracle, AWS. You're going to see a lot of people looking for government efficiencies. They've renamed the U.S. Digital Service to Doge in the name, and so they'll be looking for more modernized software. That was one of the EOs that came out yesterday that I think is super interesting and a little bit overlooked.
Yeah, and reportedly, Oracle's Larry Ellison did dine multiple times with Trump, Nikki, so relationship there. Thank you so much for joining us. Appreciate it. U.S. stocks closing the trading day higher as Trump holds off on tariffs. Yahoo Finance's Jared Blickery joining us now with the trading day takeaways. Jared.
Thank you, Josh. We got to talk about a potential for a Trump trade reversal. The inauguration day is in the rearview mirror, and we are in the midst of the first 100 days, at the very beginning. And Josh, I had a chance to sit down with Tom Hayes of Great Hill Capital in an episode of Stocks in Translation, and he reminded me of something that happened under Trump 1. Let's take a listen.
As soon as he was elected, dollar rallied, yields blew out. Emerging markets and international stocks sold off. And then after the inauguration, what's surprising to most people that they forget is that bonds actually rallied, yields compressed, the dollar came down, and international stocks did exceptionally well. China had one of its best years ever in 2017 after the inauguration.
All right, so I'm keying in on the dollar. This is the U.S. dollar index going back 3 months. The election was right in here. The election was right in there. And here is the high. And in fact, this is a multi-year high. And 110 on this instrument is a problem because we talk about that dollar wrecking ball. What happened yesterday, we had the biggest decline in the dollar going back to 2023. Today, we rallied back a little, but then we sold off again. This tells me that we might have the potential for a reversal of the moves that we've seen. Some of the moves that we've seen since the inauguration. And here is what happened in Trump 1. From election day to inauguration versus first 100 days, we saw reversals in the U.S. dollar index and the U.S. 10-year Treasury yield. Those were up, those came down. And then gold and Bitcoin, which had been down, those went up. I'm not necessarily looking for those same moves in gold and Bitcoin, but I was looking at some of the index trades, and they rallied throughout this entire period, both before and after. It was just a change in the sector composition.
So I'm a trader, I'm an investor, and I'm listening to this, Jared, right now. I'm saying, hold on, with all these reversals, is Jared Blickry telling me that we're going to see a reversal down for stocks?
Yeah,
is that what he's saying?
Yeah, that's a good question. What I noticed is that small caps had been leading under Trump 1, and then they gave way to the Nasdaq. What happened this time? Small caps have been lagging. The Nasdaq has been outperforming, so maybe that's what reverses. But I don't expect either to go down. I think they just go up at different rates.
All right, Jared Blickry, point number 2.
Point number 2, no landing. That no landing scenario to new heights. And this comes after the Bank of America fund manager survey. They survey people managing money of about $500 billion. They come out with these opinions, and it's interesting. No landing rose to 38%. That is the highest in their survey period, at least the chart that they show, in 2 years. And it doesn't quite beat soft landing. So soft landing is still at 50%. That's higher, but that is on the decline. And then hard landing, that's a recession warning. That's only at 5%. So not a lot of people thinking that. But no landing, that mid-cycle expansion, that is on the rise. And it kind of ties into this chart that I have right here. I borrowed from B of A. And this is a percent of these fund managers, these money managers, that's saying they're expecting to see above trend growth and above trend inflation. This chart goes back to 2009, basically. And you can see we had this huge boom here in 2021. That was that inflationary episode. We are back to a critical level that we've seen before. So we might either reverse and turn down here, or we might go higher. But the street is saying they expect things to go higher.
In this survey, in terms of like bullish catalysts and concerns, how was that shaken out?
All right, so bullish, the biggest bullish growth that we're seeing potentially is China. So if China reaccelerates, it's not a fait accompli. But remember, we just heard from Tom that in Trump 1, China had its best year in 2017 in a long time. Could happen again. That's one. Fed rate cuts. That's 17%. Global trade or AI productivity. That's also another potential bullish catalyst. Now, the bearish catalysts are interesting. Disorderly rise in bond yields. That's something we were worried about recently. Fed rate hikes and then a global trade war. Those all kind of balance out there.
All right, good list. Final point, Jared.
We got to talk about crypto because we have seen some huge moves in Bitcoin. And let me just pull up a Bitcoin chart here. And let's get the heat map so we can see the entire crypto universe. But Bitcoin yesterday rose to a record high, rallied to a record high, and then it sold off rather sharply. So it went to about 110,000. And let me just get the chart here so I don't misquote the number. It went to about 110,000, came all the way down to the 90,000s, and now it's back up to 106,000. A lot of people looking at this, especially yesterday, were saying, okay, this is a double top. I think it's way too early to say that, but here's how that would look. You have this right here. Here are your two peaks. You need to crack 90,000. 90,000 has been my land in the sand for a long time. We broke it just very momentarily in January, and then we raced to new highs just recently. I think this is a very bullish looking chart, but this is only Bitcoin.
What about the new Trump coin? Are you a buyer, Jared?
I am not a buyer of the new Trump coin necessarily, but critically, that has been built on the Solana token. And if I put a 5-day and I sort by equal weight, you can see a lot of red on here. A lot of other crypto tokens in the universe, a lot of competing networks have not taken the news well. Cardano, for instance, is a competing network, didn't do so well. Solana up 15%, while Bitcoin is up 2%. We're going to see winners and a lot more losers under Trump. That's my prediction for crypto.
Right. Thank you, Jared. Appreciate it, my friend. Stick around, much more Ask for a Trend still to come.
Big focus by the global business community on the new Trump administration. What will the administration do? What won't they do? Let's zero in on that global vibe here with Suntory Holdings CEO Tak Niyanami. Tak, good to see you here. A little cold this morning. We could use some whiskey. Definitely. So what is the vibe overseas when you look at what the Trump administration, of course, a very downbeat inauguration speech by new President Trump. How is the global business community thinking about working with the Trump administration?
First, it's a kind of relief that President Trump didn't give the hardship to China, because once that happens, like 60%, that will increase definitely inflation in the United States. That's the one of the most important markets for us. And the U.S. is a big locomotive to the world economy. Only one economy which can lead toward the better economy in the world. So that's a big relief. But Canada, Mexico, 25% tariff. It's not a good idea. But we have to deal with the tariff policies to be given to the world. We have to respond quickly to the policies.
And there's this talk now of a potential 100% tariff on China. What signal would that send to the rest of the world?
Well, I think the world will be in inflationary scenario, because U.S. will be worse in terms of the inflation, problems. So I think it's not realistic, because still U.S. relies on goods from China. So, and considering the midterm elections, President Trump has to think about what to do with the inflation. Inflation is the most important issue for the U.S.
Have you started to, if there are tariffs on alcohol and whiskeys, what does that do for your business? And have you started to prepare your operations for that?
Right. We are preparing that the tariff from European continent to bourbon and vice versa. I think we've been preparing for it, because that disputes started well before. So we are preparing for that. But nowadays American whiskey is well accepted by European consumers. So that creates a kind of a huge negative sense. But in the meantime, we can increase American whiskey consumption in the United States too. So, and plus, we can take it to other countries like Brazil, Japan more, and ASEAN countries. So we can expand geographically. So I think we can make a successful landing because of the tariff to Europe.
Have you had to stockpile whiskey in Europe?
Yes, and so we've been piling the our products in Europe, but it's not enough.
How long would it last?
I think at least a year.
So a year worth of stockpile whiskey.
I think so. Yes.
Would tariffs mean whiskey inflation on U.S. consumers?
I think a little bit, but U.S. consumers are wise enough to choose American whiskey, because nowadays a variety of American whiskey we offer, and plus just like Japanese whiskey, we can offer more. So I think and plus now that the trend is toward the RTDs, so we can satisfy American consumers by offering many measures.
Are you more inclined to invest more in American whiskeys now with the new administration in tow? And if we do get tariffs, would that incentivize you to build more plants in the U.S. or launch new U.S.-focused brands?
We do, so that not only increasing volume, increasing the quality, and we need fine-tuned machines, and we want to train people. That's the foremost, and investment not only the assets but also humankind. That's so important.
Since I last talked to you a couple months ago, I think it was on my podcast opening bid, we had a warning from the Surgeon General on alcohol risk, and you've always said moderation, moderation, moderation. But when you saw that, does that change how you approach marketing alcohol? Have you seen an impact to demand after that?
I don't see any clue influenced by the announcement by Surgeon General. But we have to be in a moderate drinking campaign more together with the industry peers. And plus, we are working to increase the RTD space, non-alcohol and less alcohol. But anyway, this trend of less drinking came out of the demand of the Gen Zs. So we are prepared for that.
Do you think, is it a longer term risk? I mean, do you see it as a health risk based on any studies you've done?
Well, health consciousness started after the COVID, to be honest. I think, drinking itself is kind of culture, so it's deep rooted. So I don't think drinking will vanish at all, but the trend created by Gen Z should be taken care of by launching more RTDs.
All right, well, it's always great to get some time with you. I know time is brief at the World Economic Forum. Suntory Holdings CEO Tak Nianami, always a treat. Thank you so much. Appreciate it.
For our chart of the day, we are now taking a closer look at the surge of U.S. foreign investment. And Yahoo Finance's Julie Hyman joins me now with a closer look. Julie.
Yes, indeed. Foreign investment into the U.S. has surged to a record, according to one measure of it. And, you know, we've been talking about sort of the economic backdrop into which the Trump administration is coming here, strong by a number of different measures. And when Trump says that the U.S. is open for business again, well, this would indicate the U.S. has been pretty open for business. Now, this measures what are called greenfield projects. That is, companies building or expanding facilities in a foreign country, in this case, the United States. And this looks at the number of projects that we have seen, 2,100 in the 12 months through November. This is data collected by a company called FDI Markets, which is owned by the Financial Times. You can also measure it sort of on a percentage basis. So we saw the proportion of these new projects to 14.3%. So attracting 14.3% of global investment into foreign countries, wherever they may be. And what this chart looks at is not just the US, where we saw that record 2,100 projects, but how it compares to the UK and China in particular. And you can see both of those have been trending lower for the last at least 5 years or so, call it. Now, part of this is, of course, is a reflection of economic fortunes of these various countries. In other words, if the economy is robust, other companies from other countries want to invest into that to take advantage of the growth. There also have been some policies that have attracted investment. After all, one of the industries that's been gaining a lot of investment has been semiconductors. That, in part, has been spurred by the CHIPS Act under the Biden administration. But also, we have seen investments into industrial equipment, construction, electronic components, renewable energy, and aerospace. So all of that contributing to what's going on here, Josh.
Yeah, we talked to PIMCO's Libby Cantrill about it, Julie. She said, listen, bottom line, U.S. is the cleanest, dirty shirt out there versus Europe and Asia. Thank you, Julie. Yeah. That is a wrap on today's Ask for a Trend. Be sure to come back tomorrow, 4:30 p.m. Eastern, for all of the latest market-moving stories affecting your wallet. Have a great night.